Well, hey everyone, I trust this video finds you well. We've had a super exciting couple of days. We've just launched the Generational Wealth Fund, so I hope you saw that video. If you haven't, go out and watch it. I've linked it in. I've linked the video in this email, but I sent it out on Saturday last week, and we've had some great response, and I'm really excited by that. But today I want to talk to you a little bit about how your money is invested for most people, or for many people, if they're in a 401k or an IRA or Roth IRA, whatever it might be. If you're investing in the stock market through a brokerage firm like a Fidelity or a Charles Schwab or someone like that, Vanguard, I want to show you how your money is invested and kind of what happens behind the scenes. For most people, they hear the upfront stuff, but they don't really know how things work behind the scenes. And I think this is really important because when you understand how it works, it'll help you to make better decisions about how your money is managed. So the first thing I'll say is that there's a big difference between what you would call passive management versus active management. Okay, so passive management is effectively you put your money into the market and then you leave it for a period of time. And there might be small adjustments here and there, but they happen very infrequently. They happen from time to time and for significant reasons. But generally speaking, your money sits in place for a long period of time without very much involvement. That's why it's called passive. Then active management or a managed fund is really one where the people running the fund are trying to effectively beat the market. And so they're making decisions on a daily, weekly, monthly, yearly basis. I mean, sometimes several times a day, depending on the fund and what it's trying to do. And effectively, they're just trying to beat the market and outperform. The reality is that managed funds over the long term, okay, so short term, they can do really well. But over the long term, they very rarely, if ever, beat the index. They very rarely, if ever, beat a passive fund of, let's say, the S&P 500. And the reason why is it's just difficult to pick winners and losers on a daily basis. I mean, there's days when you can be up and there's days when you can be down. And just because there's so much human emotion and fear and greed and all those other things that come with it, and sometimes just self-interest on the part of the manager, that it's very easy for them to make mistakes and to either overextend or miss or whatever it might be. And so I just want to show you quickly what happens behind the scenes, how these funds are made up, what they're comprised of, and this will give you a better understanding into how your money is invested for your retirement. And just to say from the outset, this is not to say that you should do something different or that you should change out of where you're at. I just want to explain how it works, whether it's right for you, whether it's good for you, whether you want to continue in that or do something else, that's up to you. But my goal is just to help you understand what goes on behind the scenes. So the first thing I want to share with you is I want to show you the S&P 500, which is a collection of obviously the 500 largest companies in the US. And when most people talk about the stock market, this is what they're talking about. You hear the Dow Jones. The Dow Jones is 30 companies. It's a lot more volatile in the sense of, those big companies can have a swing and it impacts the index a lot more. When you have 500 companies, it tends to be a little bit more stable. They tend to kind of track each other in many ways, but I like the S&P 500 for various reasons as a better measure of how the economy is doing and how the market is going. So obviously, unless you've been in lockdown with no TV, you've heard that the market has just gone up like crazy in the last couple of weeks, and so we've seen a significant rebound. So let me just show you a couple of quick things that are worth mentioning. So obviously, if you look over the past year, and this is how much the market has gone up, right? Like the market has actually brought in a positive result. If you'd invested, right, if you invested last year, June the 6th, to this year, June the 6th, even with the drop, right, the significant drop, you still would be up. Not a lot, right, but you would be up just slightly, okay? Now, for some people, if they would have invested here, which was obviously the worst time to invest because this is when the market was at the peak, okay, and then they would have sold on the bottom, they would have lost 33.92%, so effectively 34% from the peak to the trough. Okay, so for some people, they freaked out and they sold. I mean, here is the thing, and this is going to sound really basic, but the only way that the stock market price is displayed is when there's a buyer and there's a seller. So when someone is willing to sell and someone is willing to buy, the transaction happens. And when that transaction happens, the stock price changes. It reflects the new price. And as people are prepared to pay more and more and more for stocks, then the price goes up. And as people sell stocks for less and less and less and less, the price goes down. It sounds really basic, but what people don't think about is the psychology behind it. As you're sitting here, say you own stocks at this point, and you start seeing the price go down, you think, uh-oh, what if the price keeps crashing? So I'm going to sell my stock. Someone else thinks, well, maybe the stocks will just go down temporarily and come back up. Now, nobody knows at that point. But these are the bets effectively that people are making. And so have a look what happens. And if you look at a kind of a chart that's more close in, that was a 1 year chart, this is a 6-month chart, you can sort of see, right? You've got the peak up here. And so the people that sold are the people that went on the way down. And then people got a little bit of confidence. You see, you got a bit of a spike and then a drop and a spike. People are thinking, you know what, maybe the drop, this is as big as it was going to be, right? Not a huge drop, but this is as big as it was going to be. And so when that happened, some people started to buy. Then you had another drop, then you had another rise, and so on. Until it hit the bottom here. Now, I'm not saying that this is the permanent bottom. We could see another bottom the same or worse than this in the future. Nobody knows that. But my point is, there's always a bottom in hindsight, but not during the time when you're in the market. And so all these people are making bets on the future. These people here, where the market has risen up significantly, are making a bet on the future. I mean, if you look from the bottom to today, there's been a 42.75% increase effectively in 2 months. Right, so from March 31, when kind of we saw what they would call the bottom, you've got end of March, so kind of a week, and then you've got April, May, and then we're now just in June. So basically 2 months and a week to 2 weeks, 2.5 months, and you've seen 47. I mean, it's just a crazy uplift. And so you think, well, okay, how do I judge this? What do I do? Well, the reality is you see these massive drops, but this is because we're focusing in on it. Have a look, over a year. Have a look over 5 years. I mean, yes, it looks like a significant drop, but you see, if you go back to all these other drops that we've had, you see how they start to be smoothed out over time. And then if we go over a 20-year time frame, okay, again, it looks even smoother. And so, yes, there's significant drops, but you see there's a significant drop here back in 2018. There was a significant drop back in 2008, 9, when we had the financial crisis, right? There were significant drops here, 2003, 2002. So again, my point is, in the moment when you're zoomed in, it looks really bad. But when you look over a really long time frame, you can see that over the long term, the market continues to go up. And that will continue to happen and has done so for 100 years and will do so for the next 100 years. The market will continue to go up. Now, not every stock in the market will continue to go up, and not all of them at the same rate and at the same time, but over the long term. And this is the challenge with trying to pick winners and losers. And so how does it look on the back end? And this is what I wanted to share with you today, so you can get a sense of the inner workings in these funds where your money is invested, oftentimes for people with retirement accounts. So I'll show you this quickly. So there's different kinds of funds, but let me talk about an index fund and an exchange traded fund. So an exchange traded fund, or an ETF, you would have heard the term ETF, is kind of like an index fund, but basically contains or has some benefits attached to it, which I won't get into. You can Google exchange traded funds versus index funds. But overall, index funds tend to have a bit of a higher cost base. It's about 0.74%, which means that for every $1,000 that you invest, okay, for every $1,000 that you invest, about $7.44 goes into managing the fund. And for exchange traded funds, it's about $4.40. So the point is that there is a cost to having these funds, right? And so your IRA, your 401k, your Charles Schwab, your Fidelity, your Vanguard, all of these different companies invest in these funds. But what does it actually look like on the back end? Because you might say, I'm invested in a balanced portfolio. And so what you'll see when people say balanced portfolio, it'll look something like this. So they'll say, this is your money. And they will say, we're going to invest 60%, and it depends, everyone's different, 60% in stocks, and say 40% in bonds. Okay, bonds typically are less risky, okay? So you've got, something like this. So this would be your stocks, and this will be your bonds. Okay, now everyone's different, but within this particular portfolio, it's made up of a number of ETFs and other funds. So let's say, take Schwab, for example, right? Say you've got your money invested with Schwab and you put your, $1,000, $20,000, $50,000, $100,000, whatever it might be. Okay, when they say that they're buying 40% bonds for you, here's what's actually happening behind the scenes. So these bonds, this is also made. So if bonds is 40% over here, right? So the 100% of the 40%, in other words, your total bond portfolio is actually made up of multiple other bond ETFs. So these are other companies or other funds, okay? So this could be the ABC ETF, the XYZ ETF, and so on. So your portfolio is invested in a bunch of others, and that ABC ETF could be invested further into others. I mean, it just depends on how they're made up. And it's the same with stocks. Your stocks will also similarly, if this is 100% of your stock portfolio, they'll also be invested in various other ETFs, stock ETFs, okay? What does this mean? Well, the thing to understand about this is that every single one of these ETFs has fees attached to it. Okay. Every one of these has fees attached. Every one of these, all of these are fees. So on top of you being charged fees for here, because of course Schwab wants to be paid as well, you're paying fees on every single one of these. And every ETF that they invest in has a management board, has offices and expenses and overheads. And so all of these, every single one of these companies and sub companies that your money gets invested into, all clip a little bit of the ticket on the way through. They all take money out for managing your money. So the bonds that you put in this 40%, and you think, well, I'm putting 40% into bonds. Well, you are, but you're putting it into other companies or other ETFs that invest in bonds. And those can further invest in other bonds. So you can see how the financial industry makes its money is because when you send your money out there, they divide it up amongst all these other companies that they themselves potentially own a bunch of other companies or a bunch of other ETFs. And so everybody on the way through gets, might be just fractions of a cent, but when it happens over, billions and trillions of dollars that are in the market, you can see, the financiers are not going hungry, right? Wall Street makes plenty of money. Financiers do really, really well. And so the thing to understand is that when you let somebody else manage your money, like a Charles Schwab or Fidelity or Vanguard, and again, I'm not saying it's good or bad. You can do really well if you stick with it for the long term. But my point is just understand that there are so many hidden fees and traps and things that you won't see because they're not going to sit there and talk to you about it. It's in their disclosure statement, some of it at least. But to really understand what all the fees are, what you actually have to do is go into this section here, say your bond ETF, and look up what do they invest in. And this one will say, well, we're invested in these 20 companies. And then you have to look at those 20 companies and say, okay, for company one, what is your fee structure? Company two, what is your fee structure? Company three, what is your fee structure? And then you add them up and you get a blend and you can say, okay, well, overall, I'm paying about this percentage for my bond portfolio and I'm paying this percentage, for my equity portfolio. So hopefully that makes sense. The key to understand with this is that just because you think, well, I've just invested it in Schwab or Vanguard or whatever, that's where my money is. It's actually not. They're, in many ways, they're an intermediary. They're a big aggregator of all this money from all these different investors. And then they're out there really kind of investing that on your behalf into a bunch of other companies or ETFs that are also trying to invest into other companies and ETFs. And so think about it, there's an inherent, what's the word I'm looking for? There's an inherent disconnect, if you will, between what the investor needs and what the company needs. The company wants as much money as possible because they get paid a percentage of the money that you put in. They're not getting paid by how well you do. They get paid by how much money you put in. And then it's in their interest to send the money in different places so that all those other people get paid on the way through. Okay. And so just understand that, that everybody has to make a living, right? So that's okay. There's nothing wrong with that. But just understand that behind the scenes, when you invest in some of these funds, when you invest in your IRA or your 401k or whatever, it doesn't just go into one place and kind of sit there. It gets divided up amongst all the industry and all the various places where you've got investments. And all those places will charge you various fees at different times for different things. And sometimes there's some really nasty things. Like I was reading a product disclosure statement from Charles Schwab the other day on bonds. And, sometimes you will purchase a bond from Schwab, but here's the thing, they can also be the one selling you the bond. So they charge you fees as the customer for the bond that you're buying. And then they also set the price of the bond that you're buying. So I'm not saying it's a conflict of interest, but I certainly don't like the person being on both sides of the transaction, because then they win on both sides. They win with me as a customer, and then turns out that I'm not really buying bonds from someone else. I'm buying them from Schwab. So I'm not suggesting to do anything illegal, but it doesn't necessarily mean that I'm going to get the best deal. Okay. So just remember that, in the financial world, I was a banker for 10 years. I've been in the financial industry for a long time. Just understand that oftentimes people aren't willing to bet on themselves. the way that they make money is by passing the risk onto you. And so effectively, they get paid because you trust them to manage your money. They don't get paid because you perform for them. And so because of that, their goal is to get as much of your money as possible and share it around as much as possible, because then they can clip the ticket on the way through from other people clip the ticket on the way through from them. Again, I'm not saying that anyone's doing anything bad, although we've seen some bad cases, but just understand, read your product disclosure statement, do some Googling. How do ETF managers get paid? How do index managers get paid? How do hedge fund managers get paid? I mean, these are things that you need to understand, because, ultimately, if you don't know how your money is managed, if you don't understand the fee structure, it can make a very, very, very significant difference to the way that your money is invested and the results that you're going to get over a longer period of time. So again, just a quick video to hopefully give you some information that you didn't have before. So I encourage you, if you're investing in the market through any of these mechanisms, again, I'm not suggesting that you change. I'm not suggesting you do anything different. What I am suggesting is that you just educate yourself, understand how it works, and then you can be a more informed investor. Thanks. Look forward to speaking to you in the next video. Blessings.